And Roger, as a former Fed vice chair, I will ask you to wear that hat for the moment here. What's the Fed think when it sees this? We were hoping we could say that inflation had potentially peaked. That's not the case, and I think people are looking at a much longer game now. It may have been what Jay Powell was thinking all along, but I think the market is finally catching up with that.
I think you put it right, Becky. Jay Powell and others have been saying a long way to go. Do not want to be deceived with short-term moves. And the market, I think, was hoping against hope and against reality, not only that inflation was peaking, but that would allow the Fed to lift up a little bit, and maybe move a little more slowly. So I think now, finally, the markets and the Fed are much more closely aligned. The markets are now expecting what's called the terminal rate, where the Fed stops, to be, somewhat higher. And they, I think, are starting to hear rates are going to stay high for longer than maybe the market had originally expected before yesterday. So, from the Fed standpoint, this does not mean job is done, but hopefully things are better aligned.
Yeah, nobody's ready to say mission accomplished at this point. That is for sure. Yesterday, as soon as we got those inflation numbers at 8:30, you watched the Fed futures move drastically. All of a sudden, it was an 80% chance that the Fed would move 75 basis points next week. And I think the biggest surprise is that the other 20% think it's going to be 100 basis points. What are the odds of a 100 basis point hike at this moment?
I think it's not impossible, but the 75 is far more likely for a couple of reasons. One is that is primarily what's priced in, and sort of go with that, so to speak. But secondly, 100 would really be, I think, very surprising and would be, quite disruptive to markets. I think what the Fed would like to see is for markets to take on board the lesson, move to, tightening, so to speak, but without creating, massive turmoil in markets. And I think 100 would be, more disruptive than the Fed needs at this stage to make sure it gets its message across and to make sure that markets transmit, the tightening of financial conditions that the Fed wants, but do so in an orderly way.
Roger, let's keep your Fed hat on, but let's also add your former CEO hat and start thinking about inflation expectations, because that is the game. That's what Chairman Powell has been saying for a while. Inflation expectations are what we really have to watch. When workers see that inflation prices are up another 8.3% year over year, they can very easily make the case to their boss that, hey, you've got to raise my wages because I am basically working for less buying power than I was a year ago. That's the type of wage price inflation spiral that everyone worries about. And I think that's the game these days. We've seen a lot of cases where workers are negotiating for 14% increases, and they haven't even agreed to that when it comes to some of the railroad unions at this point. You've seen price hikes that people are anticipating paying from a lot of different companies that we talk to. And then you see things like the California minimum wage increase for fast food to $22 an hour. What does that tell you about the idea of how persistent these inflationary pressures are going to be?
Well, first, it does tell you they're quite persistent. If one looks at, much of what was driving inflation, it has been, tight labor markets, two openings for every unemployed person. Most recent data has shown that participation has inched up, but hardly have we seen large return of individuals to the labor market. So one, labor markets are tight. Two, wearing the CEO hat, you're absolutely right to say that in my surveys and conversation with CEOs, they still see quite a bit of pricing pressure in the pipeline. And so they were not in the inflation has peaked camp that the market was hoping for. There is some good news, which is the most recent surveys do suggest inflation expectations are still contained over the long period of time, but I think relatively high, slightly above the 2% number. So I would not argue that one should be at all complacent about that. And you've put your finger on exactly the biggest risk that the Fed is concerned about. We may be potentially seeing the beginning of that, or we're certainly seeing how sticky inflation is, even if inflation expectations have not moved. So the Fed has got both problems: sticky inflation that doesn't seem to be coming down closer to 2% at all, and the risk that wage price spirals start to build in with inflation expectations maybe potentially becoming unanchored. So it's a very difficult and challenging time for the Fed right now.
Shepard Smith here. Thanks for watching CNBC. on YouTube.